One question we get about the balance sheet a lot is, why is it prepared as at? What does that mean? Well, we've got to sort of do a little bit of accounting theory about this, but then it sort of makes sense in a much easier analogy. So let's start with the theory. Accounting assumption number 2 was the going concern assumption, and that is the financial reports of the business are prepared on the assumption that the entity will continue to exist and operate into the future, will not be wound up in the near future, and will continue its activities as a going concern forever. So if we say here's today, and time, well, it's ongoing, it's infinite for the business. We don't say it's going to stop here or here. We say the life of the business is infinite. However, we also had another accounting assumption called the period assumption, and that said the financial periods of the business must be prepared or must be split into periods of equal time, e.g. a month, half year, no longer than a year. Why? So we can compare our results from one period to the next. We can determine our profit for each period by matching our revenues with our expenses. And we can draw a distinction made between expenses and assets. Let's not really consider this bit here. Let's just say we want to break the life of the business into periods of equal length so we can compare results over periods and calculate our profit. So how the period assumption works is we take this ongoing life that has no end, and we say, well, that's, kind of good that we assume that, but we really should break it into periods of equal length. How do we know how we're going, and how can we measure our performance? So what we need to do is not just say, well, let's just do it here or here, like arbitrarily. No, what we're going to do is take that period concept and go, the periods have got to be of equal length, and we stick to it, so we choose monthly. So there's 12 in a year, monthly, 12 in a year. And now we can compare January here with January here, etc. Or we could do it 6 monthly, which we call half yearly. So in 2021, there's 2 periods. 2022, there's 2 periods. Or we might do it yearly, in which case each year is 1 period. We could also do quarterly, which is every 3 months, which I didn't put there, but that will come up too. The point being, it can't be any more than 12 months. One reason being the government wants us to do our taxes every year, so we can't actually have a period of longer than 12 months. But the point is, the life of the business has been broken into the periods of equal length. So we can now compare produce our performance and determine it, and also compare it over time. So I guess what we're saying is we need to divide the continuous life of the business into periods of equal length. And what we're doing is, let's just say we're doing this for January, and at the end of that, we calculate our income statement, cash flow statement, and balance sheet. Now we're just looking at the balance sheet now, but the point is we're measuring our performance with these 3 reports. Then February happens, we're measuring our performance with these 3 reports. Then March happens, and same. So no matter the period length, we stop, we measure our performance here with these 3 reports. And what we're getting now is a little closer to, well, why is the balance sheet as at? Because it just means what was your financial position of your assets, your liabilities, and your owner's equity here, as at the end of January, or as at the end of February, or as at the end of March. And what you can think about as at is it's kind of like a photo. It's like a snapshot. And when you say, what did you look like as at when you were in year 8? Okay, well, there'll be a photo that shows you looked exactly like this as at when you were in year 8. Okay, well, that's what this is. It's a photo. We are just taking a photo of the business as at a certain date, and that photo shows us what are our assets, what are our liabilities, what's our owner's equity. Then we take another photo. And then we looked at all the qualitative heuristics, say that's really good because it's relevant. We can now make decisions. And then we take a photo as at the end of February of the assets, the liabilities, the owner's equity. Now we can make decisions. And then we take a photo as at the end of March. That photo shows us the assets, the liabilities, the owner's equity, and now we can make decisions. So to summarize all that, why is the balance sheet titled as at? Well, we could say it's because the life of the business is assumed to be continuous, and we need to therefore divide that life into periods of equal length. And then we prepare the balance sheet as at the end of these periods, for example, monthly, so we can see the financial position of the business as at that exact time. And what you want to think about is, it's a snapshot or a photograph of the financial position of the business as at that exact date or time. And why we do that is we can now make decisions about operations, which helps us fulfill relevance.